Good afternoon. I can't tell what proportion of this crowd is here for the shade versus here for the conversation. So we've got a lot of ground to cover and not a ton of time to go over it. So for this first question, let's pretend that I'm Ian Capital, private equity firm to the stars, and I just got books on both of your firms. What would you guys say, and you can use a little bit of an intro, what would you guys say makes your firms valuable? What is the core of your firm's value proposition, and what would you highlight on the pitch deck?
Sure. Andy Watts, president of Vantax Wealth Management and leader of the tax channel for Cetera. So I would first say within Cetera, the tax channel itself is unique in the sense that historically we have primarily recruited CPAs and enrolled agents to be both, obviously the tax professional, the accountant, but also the financial advisor. And I would say that history has evolved into not just saying we're going to recruit exclusively CPAs, but we've also evolved into saying, look, the right thing to do is apply the lens of tax to wealth management. And so we've enabled those CPAs and enrolled agents to apply their craft in a more effective manner. And looking at how we can do that more broadly at Cetera as well.
Hi, I'm John Foster, President and CEO of Angelus Wealth Management. So I think Ian is sort of asking, what's the elevator speech? It's a good place to start. So our targeted client is the $10 to $100 million investable asset client. And so that value prop would be is that clients in that space, they're flying first class or they're pulling out their NetJets card, but very often their portfolios are still sitting in coach at a wirehouse. So our value prop is create institutional quality portfolios for ultra high net worth individuals and families.
So thankfully, Ian Capital is not a real private equity firm, and if it did, it would probably be in basic economy. So let's go back to reality for a second. So maybe, John, we can start with you. When you get a real book from a real investment bank for a real RIA, what are some of the green flags that you're going to look for? So I guess, what are the valuable traits that you guys try to select for?
So you want green flags or red flags? Green flags?
Let's start with green.
Green. A real live marketing growth process. If someone says to you, our growth process is that we get all our clients from referrals, that's not a process. That's table stakes. So you want to see someone to be able to articulate how they're growing their firm through multiple channels or niches, whatever. So that's the first thing, is a repeatable, identifiable growth process, which is far in excess of what you're seeing out there in the marketplace, which is like X market's like 3% a year typical growth for an RIA, which is atrocious. That's not a firm you want to buy.
I tack onto that, not just a real growth strategy that is disciplined, that's standardized, that's multi-channel, I like that. But I would also say that's transferable, right? You don't want something to die with the seller, right? And so I would even maybe add some color to that to say it should be formulaic, right? I should be able to understand your growth strategy in a spreadsheet, in a super disciplined way. I should understand the math, your conversion, what does that look like in a basically an algebraic formula if appropriate and necessary. That helps us as a buyer then translate that into the valuation of your book.
So I'm glad that John mentioned the 3% number, because I think that gets to kind of the dirty secret about this industry, which is that most firms don't actually grow, and that the market has kind of papered over poor margins, poor operations, a bad ownership structure. So what are kind of some of the indicators or the red flags from a book that might show to you, okay, yeah, this firm might be at X AUM, but it's obvious that they're getting carried by the market and there's some serious structural issues here?
Well, a red flag to me would be, in addition to the no true growth processes, that a business that's too personalized. It's the John Smith and Company advisory firm, and if John Smith gets hit by a bus, it goes bye-bye. So is it a transferable process? Does it have institutional quality of it in some form or another where the clients won't leave if the principal gets hit by a bus?
Yeah. To further that, right, it is highly principal dependent. It is highly customized investment strategies. It's always, I would say, a value add to the end client that says, hey, look, we don't do cookie cutter approaches, right? It is unique to you. But I can tell you as a buyer, if it's not a standardized and institutional approach, then it is very hard to replicate and very hard to integrate and assimilate. And so ultimately, if it's highly customized, it's not something we would be interested because it erodes value long term.
You're saying bespoke does not mean good value to a buyer.
That's right. Institutional, yes. Bespoke, no.
So let's talk a little bit, we'll get to the investment side in due course, but let's talk a little bit about kind of the organic side. And I think a lot of people, I was talking to one of my sources, and they're talking about how a lot of times you think about organic growth and bringing new clients like the old Merrill way of you find the phone book, you call 400 people. And nowadays there's more, like you guys have discussed, systematized, professionalized, repeatable strategies towards organic growth. So I guess, what strategies have you guys put into place that have worked consistently? And what was kind of the amount of work or effort that had to go in to get those kinds of processes from concept to actually repeatable?
So for us, in the specialized business that we have of dealing with ultra net worth families, people hire people. So my advisor team is incredibly important to me, and I spend a lot of time thinking about their success and also what's their story, what's their message, and trying to help them craft that. And because I think that within general frameworks, there's some niche marketing that makes sense. Some people are good with women in transition, other people with multi-generational families, others with young people inheriting money. What's your message? And that message has to be something that you believe and you can speak to, and you can do that honestly. And so my strategy is to focus on the individual talents of those advisors and helping to enhance that and back it up with money and support, et cetera, so they can be successful, and so can we.
Yeah, I'd say the tax channel within Cetera and Avantax specifically is unique in that, as I mentioned before, all of our advisors, or majority of our advisors, are CPAs. And so when you think about those CPAs already having their tax and accounting book, they have the benefit of tapping into those tax clients. And those tax clients inherently trust their CPA. I know for me, I've had the same CPA for 18 plus years. And that CPA knows everything about my financial situation and my financial history. And so when a CPA says I should be doing something like investing differently, or I should bring all of my assets to them, I'm going to take that seriously. And so what does that mean for you guys? I think, number one, you should know that everyone is trying to engage CPAs for centers of influence, but for those who are truly successful, typically you're going to see some sort of a reciprocity, whether it's in sharing back a referral or, more importantly, I would say even a revenue share where appropriate. The critical challenge to that, though, is there's a lot of firms who are not comfortable with CPAs having an outside business. So that's the biggest challenge overall, less of a challenge for RIAs.
No, I'm glad you mentioned kind of the CPA referral pipeline, because there have been plenty of RIAs that have been built on the foundation of whether it's referrals from a CPA firm or from a law firm or from a pilots union. I mean, there are plenty of these firms that are built on the backs of ties to organizations. The other element I kind of think of when we're talking about systematized organic growth is the custodial referral channels. And I'm curious if you guys could maybe share your thoughts generally on how you have thought of those, whether it's Schwab, Fidelity, Pershing's obviously starting one, TD had one. How have you guys thought of those as avenues for organic growth? And if I'm a mid-sized firm now, I mean, if you think about how much tighter Schwab's program has gotten, is it even kind of worth thinking about if you're kind of a firm that's up and coming about trying to get a placement in one of those channels?
So we do not participate in any of the referral programs. I did that in my past. I think for the typical client that we're trying to focus on, there's not a huge volume of those that come through the referral channels. I mean, there obviously are some that do work their way through, but that's not, I think it's more of a mass affluent opportunity in general. So we've passed on that. I think, you know, they've all done a wonderful job of figuring out how to create fee revenue from a referral. And there are firms out here, some probably sitting here, that have done an unbelievable job in that. It requires a real dedication of people, money, time, effort, and lots of time in your car to go meet with all these people, but that's just not what we do.
Yeah, in our experience, there's value in helping you grow a business through those custodial referrals. However, not having any insider information with those, I do wonder, is there a risk to building a business that way? So number one, could they change your pricing and what they charge in terms of a referral fee? Number two, could they turn that spigot off? And so you've come to depend upon that growth and a growth strategy built around that. And if you're solely dependent upon that, there's a high degree of risk to your business model and its future.
Ian, would you say, would you say that business trades at that is discounted in terms of value and by a buyer? I would say probably is.
No, it's a good question. I mean, I think, you know, there was a TAMP out there where its entire existence was basically dependent on working with small TD advisors. And when TD sold to Schwab, the thing tried to sell itself out of desperation because its new client spigot got turned off. And so, you know, let's take a look at Schwab. I mean, we broke earlier this year that Schwab was raising the cost of referrals through Schwab Advisor Network, SAN, by 5%. And that's only about 1.25 basis points, all things considered. But if you're already paying Schwab 25 basis points, I mean, that's about half the margin on a typical client if they're over a certain asset threshold. And so, yeah, it is getting more expensive. And if that is your only channel, I mean, look, you know, I'm not paid for my opinion on things, but that can make stuff difficult. So let's put a pin on the referrals programs, and let's shift gears a little bit to ownership structure, because we pointed that out as a green flag and a red flag. So what do you guys think are the green flags you see in terms of what is a healthy ownership structure? What are some signs that you see if you're looking at a firm that you might want to bring in or that you're talking to? What would be some signs that they are actually organized well in terms of giving people skin in the game?
Well, the first thing as a buyer is to make sure that the people that control the business and the clients actually share in the equity. I know a number of years ago I made an offer to buy a wealth management firm, a fantastic firm, and it was contingent on the owner recutting the equity before close, which he refused to do, so I didn't close. And in fact, that business was sold to someone else and then disappeared 5 years later because the talent felt under-equitized and they all left. So is make sure that the people that, you know, that whoever you're buying or what you're constructing as an operator, that you've thought about, you know, the fact that your advisors are your clients too. And, you know, every day Elvis leaves the building and the fans go down the elevator with him or with her. So your advisors are really important. Make sure that they feel that they're being treated properly from an equity standpoint.
Yeah, I would say in addition to that, while it's not a requirement, I think there's value in a W-2 relationship and a W-2 advisor versus a 1099 advisor when you own the business. So in other words, if you are the primary owner, I would want ideally those producing advisors under me to be W-2 versus 1099. The reason being, I have a lot more control, I have a lot more influence, I probably own the clients unless I've contracted that away, but that protects and insulates the enterprise value overall.
Andy, do you mean in 1099 is that they're sort of, it's an ensemble, you know, and that they have their own book per se, because it could be a 1099 structure, but they're actually all in the same team. But right, are you buying one business or are you buying a book of multiple businesses?
Individuals. That's exactly right. Case in point, there's an advisor of ours here in Florida who saw a decent amount of his book of business walk out the door, and that employee that left was a 1099 advisor of his, and their contract between them was not sound enough to enjoin those clients to the firm. And accordingly, right, he had no recourse except to hopefully win in a court of law versus pointing to the contract and saying, no, these are my clients. You leave them alone.
Well, I'm glad you. Thank you for bringing up the Elvis analogy because it's going to be very useful for the story that I'm going to talk about now, and that is when I think about how equity comp isn't necessarily the be-all end-all. I think of the story of Hightower, which was founded by giving breakaway advisors equity options that vested over a certain time, and the idea was that Hightower would go public, the equity would vest, and the advisors would cash in. But the IPO didn't materialize by the strike date, and so all the options vested. The advisors became elevator assets. Elvis left the building, and then the equity got crammed down when Thomas H. Lee brought in. It just shows that you can have equity as an incentive, but it's not always going to work. So I guess just from that perspective, what are kind of the structures you can place around equity comp for your top performers or the G2 that keeps them invested in the business for the long run and keeps the elevator from coming up to that floor?
So very often equity is code for pay cut. Some of you know this in this room, right? And so I think the first thing, are you G1 or are you G2? Let's leave G3 out for a moment. If you're G1, you're like me, where if you talk to my wife, I chucked in a high earning job twice and went to start a new business and my income went to zero and built it back up, and I'm a G1 person. The G2 people that come along have a different set of metrics, so they're never going to get to control the business. So giving them equity, but making them go deep into debt to pay for it and not be able to pay for braces or for 528 plans, et cetera, you're not giving them a benefit, you're giving a penalty box. So you need to think about how you structure your equity and hand it out so it's a reward and not a punishment. Because the G2 people still have a chance to leave. It's got to be a benefit.
Absolutely, and I think there's got to be not just a strike price on that equity. I think there's actually got to be upside to earn incremental equity, especially as you see the enterprise value be accretive. And so we too have seen exactly what you're talking about, where the G2 was not getting any sort of the equity from the owner, whether it be on the front end or whether it be as a part of the sale. But what we try to do is immediately step in and say, look, here's your compensation, here's your variable comp, but also here's your equity, and here's how you can earn more equity than what we're giving you right now.
Yeah, I think G2 comp is a package of value, right? It's your salary and bonus or your payout. It's how much does the firm help you be successful. It's maybe a bonus kicker, it's an equity kicker, and most importantly, they love to come to work every day and feel important and feel respected, because they're not going to get that G1 equity position because they didn't go to zero to earn it. If they want to, they should go start their own business.
I would also say, keep in mind for some G2, they believed they were going to be the succession plan. And so in those instances where you're stepping in as an acquirer, number one, you've got to know that color, right? So you can construct their compensation package accordingly. But it plays heavily into the subsequent integration and ultimately that feel of not just the clients, but also the employees too.
I think it's also worth noting that sometimes giving people equity can create almost like a free rider problem. And so there are some firms that have taken a creative approach to this. I think a lot about how Minetti Group operates. And if you don't know who Minetti is, they're a massive RA based in St. Louis, maybe the biggest firm out there with no real institutional backing. And what Minetti does is that it rebalances its equity every single year based on advisor production and business development. So it is kind of based on what have you done for me lately. If you're not driving new business to the firm, if you're not producing, then you don't get to hold on to it. You're forced to sell it. And so it obviously creates competition, internal competition, but it incentivizes people to constantly go out and you're not taking anything for granted. So let's just kind of shift gears a little bit and we think about, some of the mega valuations that firms have gotten. I mean, creative planning, enterprise valuation north of $16 billion. We see some of these firms print in the billions every single day. Do you guys think that those kinds of headline numbers might have created among some firms almost like a delusional expectation for how their own businesses should be valued or treated?
Oh, absolutely. Well, the first thing is, and you know this, like, if someone's talking about their business, they talk about it as a multiple of revenues. That means they ain't got no margin, right? And then, yeah, there's the arbitrage. The bigger you get, the bigger the multiple is. And so there's all these delusions that people say that, I have 10 million in revenues and I should be valued the same as, a Mercer or one of these gigantic companies with real margin and real growth, et cetera. And that makes them hard to buy. In some ways, it's an excuse for the owner not to sell because they really don't want to, and so they come up with something that's so ridiculous. It's like, if you have a house and there's the make me move price, which no one will ever pay that price. But you keep valuing yourself based upon something that's a fantasy, and that doesn't help.
Yeah, I think so many times you'll see folks who are new to the concept of a sale, and ultimately what they come to is, oh, well, that multiple is a multiple of revenue, as you mentioned, and that multiple is driven by anything that drives revenue. So therefore, if the market has been, in a very strong bull market, then ultimately my assets are being driven by that, and thus my multiple is. And inevitably, they are misinformed, right? And the multiple should be paid, as we all know, on EBITDA, and that's a function of the strength and the integrity of the business, not just the top line growth.
So what drives real margin at a strong performing firm?
One is size, to be big enough to be able to grow into the margin. The other one is the basic premise of a business. Like, I talk to people all the time in these conferences, and everybody's got a different business strategy. If I sit down with someone, and they say, well, I pay my reps a 60% payout. Nope, doesn't work. Sorry, you can't make money. Impossible. That's not the right number. It's not enough left over. You have to have a business that has an intelligent professional comp line, an ops line, and an owner's comp line. And they're distinctly different. You may be a producer and you also may own equity. You need to wear two different hats. But the basic business structure has to be at least at some type of scale. It can produce 20, 30% reliable margins while spending money on growing the business.
Yeah, and I think there's a few things there, right? So number one, a solid growth strategy that's repeatable, that's transferable, will ultimately drive margin. I think, to your point, John, when people are thinking about comp strategy, you should be in market on that. And certainly competitive, but in market. And if you're curious about what market is for paying an admin or paying a producer or paying a fill in the blank, all of the custodians have those available. So they've got plenty of resources and survey data there. But I think ultimately, in my mind, what contributes to strong margin is actually strong operating leverage. And so I want to know that every dollar that I'm growing is coming at a slightly reduced cost than the prior dollar that I'm spending. And so if I'm not growing operating leverage, then I would ask the question, am I really driving a scalable business? And are my margins improving?
And what's the point, right? What's the point?
So I think we're kind of basically playing, you ever watch like This Old House with Bob Vila? So we're basically walking some of these firms, hypothetical firms, through their own kind of home renovation. So instead of putting up some shiplap or putting a barn door into the pantry, what are kind of the simple, quick fixes, the basic fixes that if you're like a mid-size RA right now that you can put into place that can either drive margin or steer you out of the path of some of these red flags? It doesn't have to be a grand step, but what are the little things you can do right now to avoid these kinds of worst case scenarios we're going over?
Spend money. And what I mean by that is spend money that creates a return. And that could be building the image of your firm, public relations, creating opportunities for your advisors to become known in the community, to chase their opportunities. The first thing that ever happens when it's a down market is that all the marketing firms get fired. you should probably double up. Right? Total mistake. You got to, if you're a mid-sized firm, try to think like a big firm, but then also figure out, I'm deploying this capital for this, and what's the purpose of it, and what's the expected result, knowing full well that, especially with marketing, it's the old expression, when I spend money on marketing, I know I've wasted half the money. I just don't know which half. Right? So think about that. Is it spending money on your image and your growth and your reputation is an investment in your business, even though it reduces your take-home pay?
So I would say, number one, standardize, right? Standardize your compensation, as we just mentioned, across your entire book and advisors and producers. But also standardize your models, as we talked about earlier. You should have a standard approach for if a client walks in on Monday or a prospect walks in on Monday and they look identical to the prospect that walks in on Friday, they should get a similar set of recommendations, right? Not because they are identical, not because their needs might be unique, but rather because it standardizes the approach and makes it more transferable in the long term. Number two, I would say clean up your books. There are so many pitch decks that I've seen for RIAs of the size that we're referencing, and they're still running their Bentleys through the books, right? They're still engaging in plenty of personal expenses through the business, and that is an extra step that we've got to take to then go through and remove those things when evaluating your business.
So I want to stick with the home improvement analogy for a little bit, and Andy, you kind of hinted at this a little bit. So what are the money pits? What's the man cave in the basement with the wet bar that nobody uses, or the hot tub that needs a $50,000 repair? What are people wasting money on that can be better when that capital can be better allocated elsewhere?
You have to go first, Andy. He said you.
So I would say it's really kind of two primary areas. Although I like the idea of the man cave, it's cars, and maybe even cars for spouses as well. But it's also either vacation homes or sports suites as well. Typically see those, and they're all built around this is client attraction and client retention. I'll give this out to a top client every so often and let them stay in my condo in Florida or something along those lines. And that's a great retention strategy.
So, yeah, Andy, I think you touched on something really interesting. So if you decide to sell your business and you go hire a banker to put a book together for you, and those of us who are sophisticated buyers look at it, the more pro forma adjustments you have, the less valuable your business is, right? So don't think you can back out your spouse's salary or the car lease that's for your child in college. You're going to get crushed on that. Run your business like you're a third-party investor who doesn't want to get screwed by personal stuff thrown through the business. It really murders your valuation. It's just not worth it. And then also, more importantly, it makes the buyer not trust you. And they may not do the deal at all.
I think that what you guys are talking about, it's all downstream from the big macro trend that's shaped this industry over the past 7 years. It's why I'm here, which is that this industry is professionalizing at an accelerating rate. I mean, we're not talking about businesses that are run or owned wholly by one person. We're talking about businesses that are backed by TPG and KKR and Carlyle. We're talking about the biggest private institutional investors in the world that view this space as an investment opportunity. It's because these firms on the top, and that we talk about as examples, are professionalized. So what can you do to put in, what structures can you put in place that, or what do you look, when you look at a book, what are the indicators you see that a firm is professional, that it is on that track, and it gets it?
Well, so if you're the owner, think of yourself as the world's smallest private equity firm, right? So your deployment of capital to yourself and payout, or on things people you want to hire, things you want to spend on it. You're a private equity firm too. You just own all the equity. So think about that properly. So don't be quick to suck all the money out. Think about it reinvesting in the business. When I talked about spending money on marketing, these big guys have no problem allocating a $10 million a year, AI marketing budget to create leads. So we may not be able to do that, but we can do things in our own little way. So, don't be afraid to spend money to grow like you're a little tiny private equity firm, because you are. Don't just maximize your withdrawal of cash from the business every year. Think about how much you should reinvest like you are your own private equity firm.
Yeah, I'd say similarly, when you think about the large RIAs who are in organic growth mode, they're actively and aggressively acquiring, right? They really come down to two primary buckets. One is integrators and the others are aggregators, right? So the integrators are truly looking to maybe even go so far as to rebrand your location as their own. They're looking to standardize those models. They're looking to even standardize the technology stack. They're looking to standardize compensation, right? The aggregators are looking to not necessarily standardize all of that, and not necessarily imposing their brand on you. But my question here would be, what is going to help the acquirer ultimately achieve their cost and revenue synergies the most expeditiously? And when you can answer that question of your own practice, that's going to be how they become more willing to pay top dollar for your own firm.
So we've got a couple more minutes left, so I'm going to keep milking this home improvement analogy for all that it's worth. And so what are the storm doors of this house? So what can you do now to prepare for the time, and it's coming eventually, don't know when specifically, when we do get into a real market downturn that lasts more than a couple of quarters? Because I think about the last time that we had serious market dislocation in 22. We saw a bunch of these big institutional firms take out these preferred equity deals with PIK coupons in the mid-teens. And then in 2020 during COVID, we saw a lot of firms with and without institutional backing take out PPP loans. And so it looked like there were clear signs of stress. So what can you put in place now to ensure that when a real downturn does come and we do hit a real backslide, that your firm can come out on the other end relatively unscathed?
Well, I would say what you can do is pressure test it. So look at your income on your revenue line, but then look at your expense items and how much is fixed and how much is variable. And then do a shock test on it. Look at your P&L and then take 20% off the revenues next quarter. What happens? So part of that's going to be how much is variable, how much do you, no one wants to lay people off and do other things when markets are down, but what's your plan if you have a shock? Also, how much working capital do you have in the business? What's the plan if you need extra capital? How are you going to do it? My tendency is always to leave excess working capital in my business, and I say to my partners, why do you care? If it's in your savings account or your checking account, it's still in your capital account, but I don't want to have to issue a capital call someday if disaster happens. And so we're pretty bulletproof on that because I've pressure tested everything. So go back when you look at your P&L, if you're on QuickBooks or something, and plug in a down 20% quarter, see what happens, and figure out what you would do about it ahead of time.
Yeah, I would add, number one, you should have a standardized growth strategy, and I'll touch on that here in a second. But number two, you should have a standardized engagement strategy. And I don't just mean I'm going to touch my top 10 firms 3 or 4 times, or whatever the recommended number is, depending upon the fund family that you're listening to on practice management. I mean a standardized, here's what you get when you come on board with me and you are a fill-in-the-blank client. So a segmentation and engagement plan, because that lays the groundwork for when you are in a down market, be it a 20% decline or whatever it might be. Ultimately, I think that should be, that those down markets should be opportunities for us all to grow, both in terms of engaging new prospects and clients, and number two, driving incremental share of wallet. And if I have done my segmentation and my engagement approach and plan appropriately, that's going to make the touch points that I'm having in that down market all the while and all the better, because I'm going to be able to be differentiated from the client's other advisors, and they're going to bring their assets to me. And ultimately, on that, on the referrals as well, or rather the prospects, I'm going to be easily differentiated from the advisor who's not picking up the phone as well.
So I've got time for 2 more questions, so I better make these count. So the first one I'll throw at you is, we talked a little bit about M&A, thinking of this stuff from a buyer's perspective. What's the point at a firm's life cycle in which they can begin to start thinking opportunistically about M&A? And something that we also see in other industries is that one bad deal can destroy a company. So how, as you as a first-time buyer, what are the screens that you should be using, and how can you be selective in finding the right partner to drive growth?
So this is as a buyer, not a seller.
As a buyer, yeah.
Very dangerous, because you don't know what you're doing, right? So the whole point is, it's the same way that if you're a stock picker, you might discard most of the ideas you have. The problem with being a first-time buyer without a lot of experience is you have a tendency to buy from the person who's willing to sell to you. So you need to be willing to hunt for years for that right fit. And because if you get the first one wrong, you're in big trouble, right? So it's really about, so people always say it's all about culture. Culture's number 2, right? I always thought it was number 1, but it's number 2. Number 1 is, do you agree with how you do your job and how you manage money? If you and I are culturally aligned, but you believe you're the world's greatest stock picker and I'm an asset allocator, we might like each other, but we'll kill each other in the business. The first one is alignment. The second one is culture. And you got to spend a lot of time talking before you pull the trigger. Just because they want to sell doesn't mean you want to buy.
So in my experience, advisors do not seek enough wise counsel before they go and buy. And so, especially if the deal is substantive, I would highly encourage you to pull in investment bankers or someone who is wise counsel in this circumstance. If some of you have a BD-friendly RIA, pull them in, because they probably have done plenty of work there too. Secondly, I think similar to what John just said around culture and alignment, I think a dependency of those 2 things is ego. And so if you get the slightest hint as a buyer that the seller and their ego might not be a cultural fit or alignment for the future state, then that's a massive risk.
I think that I call it red light, green light. So you're talking to people that you like, you think you're a fit, you say, okay, we're going into red light, green light now. We're going to keep talking and talking and talking, and as long as we keep green lights, we keep going. If we hit a red light, we're just going to be friends. And people really respond positively to that, and you should think of that as a buyer or a seller. Back in my early days of doing transactions, there are things I remember that I cringe now, pushing too hard to get the deal done, and your spidey sense was correct. It's got to feel right. So think red light, green light.
Well, I will say it's very funny you say seek out wise counsel, because there is an M&A advisory business in this industry literally called wise counsel. So last, we got 1 minute, 20 seconds each. What types of firms are best positioned to survive and thrive in the current industry environment we see?
Well, let me start with a little bit of a pivot, which is that all of you own businesses. When you get to that decision making on what to do, you have only 3 choices. One is to sell to a third-party buyer, professional buyer. Second is sell to internal succession. Third is to run the business forever until the client stops showing up or you die. All 3 of those are fine. So, really, all 3 are fine. I met great people who option 3 is the right thing. That's great. So think about, don't just decide you want to be a seller because that's what you're supposed to do, and it's because you're trying to create equity value for your life's work. It may be just a great annuity stream and you love going to work, because once you sell, you're not in control. I said this to people a lot of times. If you're going to sell to me, there's a new sheriff in town. I love you. I think you're great. But you do not get to be in charge anymore.
Yeah, and I think positioning yourself for success here ultimately looks like, as a seller, planning early. The worst thing you can do is say, I'm 12 months out from wanting to sell, and I'm going to start planning and preparing and writing my books and writing the compensation now. The best thing you can do is be 20 years out and beginning to prepare for the business you want to sell in 20 years. And so preparing now is easily the most wise thing you can do.
Thank you guys so much for your attention, and we're going to take a quick 5-minute break.